What I would advise is to really think about when you're looking at a strategy or an asset or an investment portfolio that is intended to be defensive, to really focus on what it is actually investing in, what the underlying investments are, and how they might be expected to behave in different types of scenarios. So one of the phenomena that we've seen as a side effect of the reach for yield is something we call credit creep, which is basically that increasingly you've had defensive fixed income portfolios having to reach into more and more credit assets just to maintain returns as yields have fallen. So where in the past you might have seen these portfolios only invest in government bonds, it's now not uncommon for some of them to be invested in high yield debt, emerging markets, things like that. What that means in terms of defensiveness of these portfolios is that they may not behave that way that investors expect them to behave in a downside scenario. So they may be accumulating a lot of latent equity beta or hidden equity risk, which doesn't become apparent until the downside scenario manifests, and it hurts performance at the very time that you most need these portfolios to behave in a defensive way. So what I would suggest is really focus on what the underlying investment is. As a passive option, if you want something that's defensive, you can look at spaces like the very short end of the US government bond market, where 3-month T-bills are now paying you 2%, and that's about as safe as it gets at the moment. Otherwise, in a more active framework, I'd think about strategies that can actually take advantage of all of the relative mispricings and dislocations that will probably arise in these kinds of environments, and particularly think about strategies that could do well in a higher volatility environment. Historically, there's been the perception that simply buying and holding government bonds is defensive. We think that that can work in some scenarios, but we really question how reliable that is when we look forward to the kinds of scenarios that we might be facing going forward. We think that given how low government bond yields are right now, so that yield cushion is very thin, and the risks around central banks taking stimulus away, there's a real risk that government bonds actually don't behave in a very defensive way because interest rate volatility rises in these kinds of environments. A sort of guiding principle of portfolio construction, balanced portfolio construction, historically has been the idea that if you have an equity portfolio and you hold some government bonds against that, that should diversify your risk. Certainly in some scenarios we could see that working, and it has been working for the last 10, 15 years. But if you look at a much longer history, you find that that relationship between bonds and equities is really not very stable at all, and that it is heavily influenced by shifts in rates and inflation paradigms. And one of the things we're seeing now as the Fed moves towards normalizing monetary policy and some early signs that inflation is starting to come back in the US, that we might actually be in the midst of one of those shifts in rate and inflation paradigms, which could cause the bond-equity correlation to break down and have a situation where bonds, rather than being a risk diversifier for your equity portfolio, actually become risk additive to your equity portfolio.